Hello and welcome to the Beginner's Guide to Bullish Reversal Chart Patterns, where we will be unveiling the secrets to buy low and sell high. My name is Stephen Look and welcome to today's training. Now before we continue, let me just tell you what our goals are. What are our goals? What are the goals that we can look forward to in this YouTube presentation? Now, by the end of this video, you'll be able to spot a bottom in stocks. Yes, you'll definitely be able to spot the bottom in stocks, and you'll be able to buy stocks as they bottom and move higher. And by the end of this video, you also know when the stock is about to break out higher. That's a good thing, isn't it? And with that knowledge, you will know when the stock market is going to move higher. Now, 75% of stocks in the stock market will follow the direction of the main indexes. And if you know when the general indexes like the S&P 500 is going to move higher, you're going to be able to spot a lot of stocks that are going to move higher as well. Because when the tide is high, it lifts all boats up. And when the market goes up, most of the stocks will be going up. And as a result of this knowledge, you'll be able to improve your trading results. How many of you want to improve your trading results? Of course, the bottom line is very important. If you're able to know the patterns, you'll be able to improve your trading results, all by using chart patterns. Yes, we're going to learn about the bullish reversal chart patterns today. Alright, what are chart patterns actually? Chart patterns are actually the footprints of money. The footprints of money. And let's say that every day, right, there are millions of traders and investors that make decisions to buy or sell stock. For example, a trader in New York decides to buy 300,000 shares of a company, and someone else somewhere wants to sell 300,000 shares. So as a result of their intention, the shares change hands. And when someone buys or sells stocks in the stock market, the volume is actually printed on the charts. And collectively, the actions of different market participants are recorded, and together they will make a single bar or a single candlesticks on the charts. Now, why do we want to use charts? Why do we want to use charts? Now, why do we want to use charts? Why use charts? The reason why we want to use charts is we want to time the markets. And if you learn something about charts, you can actually realize that charts are very, very useful to time the markets. Hey, don't worry about people that say charts, you cannot use charts to time the markets. Maybe they do not know how, but charts are very useful, especially if you master the art of reading charts. You're going to be able to time the markets. Yes, you can. You'll be able to time your entry and exits. Yes, you're able to do so. Entry, you can time it, and also you will be able to time the exits. And you will also be able to predict what might happen to the stock. Yes, you can actually predict what might happen to a stock. Later, as you learn the chart patterns, you will realize that some chart patterns have targets. Yes, you can be able to set a target, and the target is very useful because it keeps you in check in reality. Okay, if the target is $20 to the upside, then you'll be more realistic instead of waiting, okay, I'm going to profit $40, $50 from this stock. Okay, yes, you can, but a target of 20 will help you to be realistic when you trade the stock. And when you use charts, you can actually profit in bull market and also in bear markets. So you not only are one-dimensional trader, when you learn the charts, you can actually profit not only in bull market but also in the bear market. But today we're going to learn about bullish reversal chart patterns. So naturally you have to wait for next video or learn from other videos in YouTube somewhere about how to short stocks and how to make money in bear market. But when you finish this video, you'll be able to profit in bull markets. I'll teach you different charts and how to trade the charts. And you'll be able to save time reading all company reports. Company reports can be very thick. Some can go to hundreds of pages, especially the annual reports. But you might not know the information is a bit late, or some companies, they cook their books, they will say, okay, our company is doing very well, but actually not. But when you look at chart patterns, chart patterns, okay? Chart patterns are the what? Footprints of money. Yeah, they are footprints of money. And large investors and traders, they may lie to you. They may say something else. CEOs can say something else. But if they put where their money is, let's say you see the CEO or the director selling millions of shares, right? You cannot lie to you, because all will be printed in the charts. So not only you get the truth, but you actually save time reading all company reports just by looking at the chart. And like I say, spot big whale moves. You say if a CEO decides to buy 10 million shares of a company, guess what's going to happen? He's not going to want to lose money. He wants to make money. That's why he's buying it now. And you see when a CEO or the directors of a company put 20, 50 million in the stock, you'll see the stock sometimes double or even triple, in a year's time. So we want to spot big whale moves. And some very smart and large institutional investors, they will invest hundreds of millions. I say Warren Buffett is putting 2 billion in the stock. Guess what's going to happen? Maybe he sees that the stock is going to do very well in 2-3 years' time. Yeah, that's how we spot big whale moves, when we look at chart patterns and the volume. And your chart patterns complement fundamental analysis. Yeah, it complements fundamental analysis, and it gives you confidence because you're not only going to rely on fundamental analysis, you're going to also look at technical analysis through the use of charts. And when two of them agree to each other, you have more confidence in your decisions. So let me talk about the flexibility of chart patterns. Hold on, we're going to go into each chart pattern soon, but let me tell you about the flexibility of chart patterns, why you should learn chart patterns. Now, once you master a chart pattern, guess what? Let's say you learn about double bottom, triple bottom, or the cup and handle. Guess what? You can actually use this knowledge and transfer it from the stock market to the forex market. Let's say you've been trading the stock market successfully for 3 years, and you want to jump into a forex market, and you discover the knowledge that you have in the stock market actually can be transferred into the forex market, because there are going to be double bottoms in forex, there's going to be cup and handle patterns in forex, yeah, and there'll be cup and handle patterns in commodities and also in crypto as well. Let's say you want to trade Bitcoin. And you see a double bottom that you say, hey, I have seen this pattern before in the stock market. And guess what? It works also in the crypto market. Of course, there'll be small differences and also nuances. Okay, just because the chart pattern works in the stock market doesn't mean everything will be same like in the forex market or in the crypto market. There'll be differences, like forex trade round the clock, right? And the stock market is open for 7-8 hours a day, right? So that you have to take into account of all this. That's why once you learn this pattern, you want to trade, go and do one market first instead of jumping to stock market, forex, or commodities, or crypto, because you need to learn and master the pattern first before you go into another market. Now, the other good thing I want to show you, the stock market, we will primarily be talking about stock market in the US. But if you learn these patterns, actually you can transfer this knowledge to trade in Hong Kong markets, Singapore markets, European markets, or Japanese market, stock market. If one pattern works in US, it works in another market. You know why? Because robots don't trade the market. Yeah, sometimes they do, but humans, they program the trading system to trade the markets. But who are the people that trade the market? Actually, it's humans. Humans trade the market. And when you have humans, right, there is what? There is always fear. Fear is present. And there is always greed. So when people are fearful, they will what? Sell the stock. There's panic selling. That's why sometimes you see that stock can go down. In 1 month's time, you can lose 50% of the stock. And then you can see greed, especially in near the end of the bubble, when people see stock prices going up by 100% in a week. Wow, it goes parabolic. And all this fear and greed, they actually manifest itself in chart patterns. Right? Volume will increase, volume will go up, the price will go up a lot, and then you'll be able to see a lot of different kind of patterns, chart patterns. And all these are repetitive, okay, because there's fear and greed in humans, whether it's in the 1929 crash or the dot-com bubble or the 2008 crash, right? All these are repetitive because human emotion, fear and greed is present, whether it's 100 years ago or 50 years ago or 30 years ago. And all this we can read from chart patterns, and which is why it is actually very, very good. Good for us. Good for who? Good for you and me. Good for us, because people who don't rely on chart patterns, they don't know about this. But for us who learn about chart patterns, it's good for us. And if you really master it, it'll be extremely good for who? For you. For you. Okay. Now there are some people might ask, what chart patterns are the best? What are the chart patterns that are best? There are actually no best chart patterns. Unfortunately, the goal of you learning is to learn as much as you can about chart patterns. It's like a doctor learning about the anatomy of a human body, like in medical school. Then the doctor specializes and make lots of money in that area. So in the same way, right, you need to learn to specialize. You need to learn to specialize in a few chart patterns, maybe one or two, right? Live it, study it, and trade it. Be a world champion in this one chart pattern. Let's say you learn about double bottom, daily chart double bottom, and you trade it for 1-2 years. By the end of the 2 years, you'll be so good at the double bottom pattern that you are like almost an authority when it comes to daily chart double bottom. You want to be the top 1% of the people who knows about double bottom. Don't worry if you can't master everything. If you let's learn 1 or 2 chart patterns and be very good at it, that's all you need to make money in the stock market. Alright, I know you're probably impatient now to get into the different chart patterns, but before we go into it, let me show you the 3 types of chart patterns that I've discovered. First of all, you have the continuation pattern. The continuation pattern is something like, to be continued. Let's say you watch a movie and there's part 1, part 2, part 3. That's what continuation pattern does. So the stock can move up by $20 and then it trades sideways, and certain kind of patterns develop, like triangle pattern or rectangle pattern. And then the stock breaks out of the pattern, and it's like it's telling us, hey, don't stop at there. My movie is just part 1. I have part 2 to be continued. And a lot of traders are continuation pattern traders. And once it breaks out of the rectangle, hello, come part 2. And yeah, they buy the breakout and it continues to move up by another $20. And they profit from the $20. That's for you, the continuation pattern to be continued. And there's second chapter, the third chapter, and so on. Now, having said that, continuation pattern does not occur forever in the stock. There'll come a time when stock will reverse, right? The reverse direction. If it's going up, 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 up and out, there'll become a time that it's going to reverse. Yeah, just reverse back down. Or if it has been selling off for a long time in a downtrend, there'll come a time that the stock will reverse back up. Yeah, you reverse back up, and that is where we will learn some of these bullish. We will learn about bullish chart reversal patterns, like double bottom, triple bottom, inverse head and shoulders. And when you see these patterns happen in the stock, right, it can be a buying opportunity. So reversal pattern. And then there are some patterns that are non-directional. Now, what does it mean for it to be non-directional? That means it can go either way. It can go up or down. For example, a triangle pattern. A triangle pattern can be a continuation pattern. It can also be a reversal pattern. But when you see these kind of patterns that it can be good, okay, it can be bad, we call it non-directional because it depends on which trend line it breaks out of. A triangle, if it breaks up above the upper trend line, is a continuation pattern. And if it breaks down below the lower trend line, it's going to be a reversal pattern. So some of these patterns are very versatile. Doesn't mean if you see it appear, it's going to continue in the direction of the previous move. It depends on where it breaks out from. So an experienced trader will be able to see it, especially, let me give you an example. If you see a non-directional pattern happen in a support area, a major support area, what's going to happen? Most likely it's going to go up, right? Doesn't mean it's going to go down because there's a big major support area there. So with this in mind, okay, continuation pattern, very suitable for breakout traders. Reversal pattern, which we're going to learn today, are exceptionally good for people who want to bottom fish. How many of you like to buy low and sell high? When we think about Warren Buffett, he's the one that buy low and sell high before anybody comes in, right? He'll probably be in there already. And this bullish chart reversal patterns actually allows you to participate, just like the smart investors, just as the stock is about to go up, it allows you to participate before the big moves come. Are you excited already? Are you excited? Right? So let's now, in reality, topic of this video is bullish reversal chart patterns. I could just say, in reality, I'm actually teaching you how to pick a bottom in stocks. You'll be learning how to buy low and sell high. That is my promise to you. Once you learn these bullish reversal chart patterns, you are ready to buy low or sell high. How many of you want to be known as a bottom picker? Right? This chart pattern not only applies to stocks, it applies to the stock market. It applies, the stock market meaning is a NASDAQ composite, the S&P 500, and the Dow Jones. This is the stock market general index, okay, the Dow Jones. And if you're able to pick a bottom in the stock market, because 75% of stocks move with the general market, you will be able to spot a lot of stocks that are shooting higher. For example, if the S&P 500 bottom, guess what? The Apple stock will also bottom and most likely go up. And along with it, 75% of the stocks. So what are the bullish reversal patterns that we're going to learn? We're going to deal with them one by one. We go into the structure of the pattern, and then we will go into how to trade and how to manage the trade. Yep. This is going to be a touch and go guide lesson. So if you want to learn a bit more, please like and subscribe to my channel, because my plan is to go into detail with every single one of these chart patterns. I have written an article, actually more like a guide on my website about ascending triangles. So if you're interested, maybe I'll just put a link below and you can just read it. It's I think 4,000 or 5,000 words long, and it goes into detail about the ascending triangle. But today we're going to learn about things like touch and go, as just so that you can understand it, and then you choose one or two patterns you want to specialize in. We're going to learn about double bottom, triple bottom, inverse head and shoulders, cup with handle pattern, ascending triangle, triangle, rounded bottom, bullish wedge, and bullish gap. Now, some of these patterns, maybe you come across it as a continuation pattern, but I'm going to teach you that some patterns can be bullish reversal patterns at certain special situations. So now we're going to look at our first bullish chart reversal pattern. It's called the double bottom chart pattern. Now, the double bottom chart pattern is a chart pattern that looks exactly like a W. You see a W. That's why we call it a double bottom. You know why? Because it makes one bottom here, and then it goes up to make this middle high, and then the stock, instead of going up, goes down to make another bottom, which is relatively the same place as the first bottom. Sometimes it could be a bit higher, sometimes it could be a bit lower, but that's okay, as long as it doesn't, from middle high drop until here, and you say, okay, it's like this, and you treat it as a double bottom. No, cannot. The stock needs to go down, make a low here, go up, go back up, and then drop to relatively same area, maybe about here, maybe about here. It's okay. Okay, and that is the double bottom. And then the stock goes back up, and it completes a W here. Now, how do we trade this double bottom? Let me just go through the rules first. Okay, just look at this, chart this diagram. Okay, then try to remember it, but don't worry, we'll go back to the chart this image later. Now, how do you trade the double bottom? First of all, you must look for the stock to develop two lows that are about the same. This one I mentioned just now, it must be about the same level. Not one is so high, one is so low. That's not a double bottom. Once you are certain that it's a double bottom, buy the stock when it trades above the high of the middle. Yeah. Buy the stock when it trades above the highs of this middle. Yeah. When the stock breaks above this area, let me just draw the for you to see. This is the middle. Okay. You buy the stock when it trades above here. Okay, then you put a stop loss below the entire chart pattern. Now, to get an initial target, take the lows of the double bottom to the highs of the middle and project it upwards from the middle of the pattern. Now, I just don't worry if you don't understand. We're gonna go back to the image, and I'm gonna guide you through it. This is just for you. I just put it there so that you can look at it later. You can print it out. You can screenshot and print it out, the rules. So after you enter here, you can put a stop loss here. Okay, you can put a stop loss here. This is under the entire pattern. And the target, how do you get a target? You take the lows and you take the high to the middle high here, the height to the middle high. Okay, you take it and then you project the entire height from the breakout here. You project it upwards. Then this is your initial target. Doesn't mean that it's the final target. Especially if it's a stock that's going to start an uptrend, there is no reason why you should sell everything when it reaches the initial target, because a lot of things are a lot of these chart patterns, they might be when it happens, your stock might be just be in the beginnings of an uptrend, and sometimes the stock can go way higher than the initial target. So what you can do sometimes is, once the initial target is met, you can sell a third of your shares. Right? You can sell 1/3 of your shares. Sell 1/3 of your shares, and what do? You keep the 2/3 running, right? Keep it running. Sorry, I'm not very good at using the mouse to write. Keep the 2/3 running, but you put your stop loss, you raise your stop loss right? Raise your stop loss to break even. Break even. Okay, break even. What does it mean to be break even? That means your purchase price when you buy here, maybe it's 20, here is 15. Once you reach your initial target, you raise your stop loss from 15 to 20 so that you have what? You have a free trade. How many of you like free things? Yeah, many of us like free things. You have a free trade. Right, once your initial target is met, you raise the stop loss to break even, you have a free trade. While these 2/3 of the position left is a bonus to you. You have a free trade. Now we're not going to just look at the rules and the image that I've drawn, but we're going to actually look at some real charts. So here is stock of Airbnb. You've heard about Airbnb, isn't it? Yeah. Very wonderful company that allows people to earn money by renting out their houses or rooms or, farmhouses. So many people have been benefited from this company. So Airbnb, it has been trading sideways, right? Sideways for a while, and it tries to go up, but then very bad gap down. It looks like everything is lost. But then it goes down, it trades back up, and it goes back down to form the low here that is above, that is about the same lows here. Can you see the first low here, the second low here, about the same lows, and then it goes back up. So this looks like a W, isn't it? A W, right? And this is the middle, the highs of the middle. So how do you trade this thing? You can actually buy the stock when it goes above the middle here, right? And put a stop loss under the entire pattern. Put a stop loss around here. And what is the initial target? You take the height here from the middle to the lows here. This is about here. And then you project it upwards, right? So initial target will be around here, and then it's quickly met. And I taught you about selling 1/3 and keeping the other 2/3. This is the reason why you should not just sell everything when it reaches your initial target. So if you have sell everything here, look, the stock go up so much to about 155, you have missed such a big move. And when it comes to trading, you want your winners to be bigger than your losers. Okay, you might have a 50% win rate, but if you win $10 every time and lose $5 every time, that means your profit is 2 times than your loss. And by letting the 2/3 position run, you actually make more than you lose. Like, so look at how the stock went all the way up. Yeah, nice, isn't it? Double bottom, but go up so much. And one of the ways is use a trend following tool, maybe like 20 MA. This is the 20 MA, right? 20 MA. You hold the stock as long as it's above the 20 MA. Maybe you sell here. Maybe it's here we can't see the left side here. Maybe there's a resistance here. You want to sell it when there's resistance, or sell the remaining when it drops below the 20 MA. So this is just we are in this video. We are talking about chart patterns. We don't have a lot of time to go into trend following, but if you want to take a trend following tool, use the moving average. Is actually quite good. Now let's look at another example, AMD. Maybe for some of you this is a bit heavy and stuff like that, but don't worry. The power of YouTube is you can always go back and have a look at this video again and again, and you read a lot of articles on the internet and so on and so forth. But the more you spend time, the better you will become at something. You spend more times learning about something, it's better. So this is AMD, Advanced Micro Devices. Is in a semiconductor stock. So what happened is it make a high here. This is a double top pattern, and it kind of after that just drift just drift sideways down. Terrible if you have been holding this stock. If you bought this stock here, it drifts so, wow, terrible feeling. Okay, but look at what the stock did. The stock moved lower, form a low here, go up here, and then it dropped. Oh, like everything is gonna be so bad because we're gonna go lower, but instead of dropping, it moves back up. Okay, the lows here, the second low here is about the same low as the first low here. So when we draw some line here, we can see a W, a double bottom, and this is the middle high here, and then it broke out. What is it? This is a buy signal, and traders can buy above the middles, the highest of this middle here. You can buy around here. You put a stop loss here below the entire pattern, and you take the height from the lows to the middle here. This is the height, and then you project it upwards from the breakout to get a target. And look, what the target is right around the resistance area around here. Yeah, it kind of slowed down about here, but targets are actually very good. Sometimes it may drop a little before it reaches target, and now the AMD has achieved its target and a little bit more. Okay, should you sell a third or sell everything? Well, it depends. Okay, this is not a class about support and resistance. If there's a resistance area around here, heavy resistance, then you might want to sell 2/3 and so on. But look at this 20 MA, right? It's still above this 20 MA, so you might want to be selling half or so, and consider what you want to do when it falls below the 20 MA. But 20 MA, 50 MA, 200 MA moving up, so maybe it can continue to move higher. We don't know, but this is an example AMD how double bottom forms. Now this is the first way to buy above the highs of the middle here, but there is an aggressive way to buy this stock. That means this is a very advanced way to buy it. You can actually buy the stock when it drops to around here in anticipation that you will form a double bottom. This is a more advanced technique, and you will need to use bullish divergence. Let me just go to the chart of AMD here. This is the daily chart of AMD. Is updated here. When I took the screenshot, I think it's around here. So I actually go back up here. Now this is the double bottom. Can you see it? Double bottom. I've overlaid the Bollinger Bands and the MACD. So some traders will actually, you can buy in anticipation that it's going to go up as it forms this bottom here. All right. You want to look for bullish divergence. Right, bullish divergence. See the MACD histogram, low but higher low, but here is the same low, actually a bit lower here. So we call it a bullish divergence. And if you have some kind of bullish reversal candlestick, you can actually buy around here and put a stop loss here. Very aggressive. This is very aggressive way to trade the double bottom. But I'm just showing it to give you an idea, so that you are not only be one-dimensional trader, you are two-dimensional, three-dimensional, four-dimensional trader. There's so many ways to trade the markets instead of the textbook entry here. So this is a bullish divergence double bottom trade. Hope you this is beneficial to you. Right? Maybe you have not learned it anywhere else. If it's beneficial to you, please subscribe to my channel and press the like button. Right, so that you can learn more stuff like this in the future. Alright, let's move on to the next chart pattern, the triple bottom chart pattern. Now the triple bottom chart pattern is closely related to the double bottom. So instead of just two lows, the stock makes three lows. So there's first low here, second low, and third low here, which are about the same area. This chart pattern can often hint of a bullish reversal in the stock. The areas of the low are about the same, and the psychology behind this chart pattern is actually very interesting. What happened here is the stock tried multiple times, first time, second time, third time, to move lower, only to be met with a wall of demand. There's this demand area here that pushes the stock back up every time. So the demand pushes the stock, and after the third low, this can often be the start of a new uptrend, which is why it is very profitable to trade this stock chart pattern, especially when a new uptrend is beginning. You just buy the stock, and you can actually be early in the stock and ride the uptrend higher. So how do we trade this? How do we trade this triple bottom chart pattern? Now, once you have confirmed that there's a triple bottom exists, alright, once you have confirmed that the triple bottom exists, you must buy the stock when it trades above the neckline. Put the stop loss below the entire chart pattern and take the lows of the pattern to the neckline and project it upwards from the neckline to get an initial target. So as I was saying, if the stock is starting an uptrend, the stock can move much higher than the initial target. Don't understand what this means? Let's go back to the image here. So this is the triple bottom, first low goes up here, second low, third low. This is the neckline. So how do you trade this? The moment it trades above this neckline, you buy it and put a stop loss below the entire pattern, or whichever the low is the lowest. Remember I said the lows lows, you don't need to be exactly the same area. Maybe it could be a bit lower or a bit higher, but definitely not one low here and another low is up here. Whichever is the lowest, you put the stop loss here, and to get this target, you just take the height from the neckline to lows here and just project it upwards from the breakout. This will be the initial target. If you believe that the stock is just in the beginnings of an uptrend, just buy the stock and sell 1/3 of it and write the other higher 2/3. And when the initial target is met, just sell 1/3 and raise your stop loss from here to break even to have a free trade, as I explained in the double bottom chart. The reasons that I've mentioned in that section. So let's take a look at an example. Baker Hughes. I think it's an oil company. So this stock drop all the way down here to the 200-day moving average. This yellow line is the 200 MA. So some of you, if you know that technical analysis, the 200 MA can be a support area. So this is an area of value. Why? Because many stocks will stop dropping when it reached the 200 MA. So remember here, what did you learn in the previous section? The double bottom here is a double bottom, correct? Right? If you're taken this trade here, see the target is met and go down. But here is another, if you miss this double bottom, you can actually enter here again when the triple bottom forms at where an area of value, which is 200 MA. This is a 200 MA. And if you don't believe me, go and look at many charts in the S&P 500 and you will notice one thing, that when the stock drops to the 200 MA, especially if it's a rising 200 MA, most of the time you can see the stock stop dropping at the 200-day moving average. Right? Doesn't mean it works all time, but the 200 MA is an area of value because many investors look at it. And when you see a chart pattern appear at the 200 MA, especially triple bottom, it's going to be a very high probability trade. So here we have a triple bottom, and this is a neckline. Oh, the stock gaps up above this neckline. So what does it tell us actually? That there actually may be many people who saw this triple bottom at the 200 MA, and the stock gap up because there's so much demand after this large green candle. Because there's so much demand, it gap up the next day above the neckline. This is where you should buy the stock. Okay, and look, it traded sideways, kind of boring, and you start to lose faith in it. But the pattern actually was a success. Although it takes time. That's the thing with the stock market. Sometimes it doesn't mean your chart pattern doesn't work. Just mean it's time, and a lot of times is you must stick and be disciplined. and stick to your pattern. Have faith in it. Doesn't mean it doesn't work the next day or the next week. You're going to give up on the pattern. You must stick with one pattern until you're really successful. And look, those who stick with it was actually rewarded, because this gave, right, you bought here, stop loss here. Look, so high it went. Your reward to risk ratio is so high. Even if you have sold 1/3 off when you reach the initial target. How do you get the initial target? Take the height from here to the low point here, and you project it upwards to about this area. Right? If you have sold 1/3 and right the 2/3 higher, raise your stop loss to break even, you still have a big reward to risk ratio. Now, I just want to comment a bit here. An area of value, the 200 MA. There's another area of value. This is the downtrend line. The downtrend line is when you connect many highs, high here and high here. If you connect that, and there's one high here, if you connect all the highs here, connect 4 highs here to get the downtrend line. And when the stop breaks above the downtrend line, this is actually an area of value. It tells you the trend is changing from down to up. So when you have a convergence of many technical reasons, you have a triple bottom chart pattern at the area of value of the 200 MA, and it breaks above the downtrend line. It gives you a very strong indication that the stock is going to go up. And there's actually more to it than that. Here's a bullish cross where the 200 MA cross above the 50 MA. Look, most of the time it goes, the stock trades above the 20 MA. Now, this is also another hint that trend is changing. So there you have it. Interesting pattern, triple bottom. First you have the double bottom, right, and then the triple bottom. So if you have only learned these 2 chart patterns for the entire rest of your life, you would still be able to make quite a lot of money in the stock market if you just master these 2 chart patterns. Now we're going to move on to the next chart pattern, which is the inverse head and shoulders pattern. Alright, the inverse head and shoulders chart pattern. Now the inverse head and shoulders pattern, or some people call it the reverse head and shoulders pattern, is the reverse of the head and shoulders pattern. If you look at someone's body and a head, you know what it looks like. You just reverse it. So the stock begins by going down. You form the left shoulder, then it goes up here to the neckline, and then it drops back lower than the left shoulder to form the head, and then it moves back up. It stops around the area of the neckline, and it moves back down. This time it doesn't go any lower. It doesn't go any lower. It just stops around the left shoulder, and then it moves back up. So you have a left shoulder, a head, and then the right shoulder, and also the neck line. So this is the inverse head and shoulder. If it's not inverse, it's actually a head and shoulders, which is a bearish reversal pattern. But because it's an inverse head and shoulders, it's actually a bullish reversal chart pattern. Now, how do you trade this inverse head and shoulders pattern? First of all, make sure that it's really an inverse head and shoulders pattern. A lot of people learn about chart patterns and then they kind of interpret it in their own way. But that's okay. Sometimes chart pattern is not textbook, but at least, you know, when it comes to inverse head and shoulders, there should be 2 lows that form the right and left shoulder, and the low that is lower than the shoulder that forms a head. Okay, you must make sure that there is actually a right and left shoulder and a head. Now, once the pattern is established, buy the stop the moment it breaks above the neckline. You can put a stop loss below the entire chart pattern. If you are a more aggressive trader, you can put the stop loss below the right shoulder. Later I'll show you all this, don't worry. As I said, I just put all these words here so that you can screenshot it later or print it out. Okay, we're gonna look back at the image later. To get a target, take the height of the head to the neckline and project it upwards from the neckline. That is the initial target. Remember, I always say initial. I don't say final target, because we're picking a bottom here. Why do you want to put a final target on something? That's why we have an initial target, and hopefully the stock goes up so that your reward and risk ratio is 3, 4, 5 times than your stop loss. Okay, so if the stock just started a new uptrend, it could go way higher. Yes, you don't always need to have a final target when it comes to bottoming patterns. Maybe in continuation patterns, yes, you should take your profits faster. When you're really at the bottom, don't always set a final target. There should be an initial target and see whether it can go higher or not. This is trade management. Sell 1/2 or 1/3 of stock once the initial target is met, and write the remaining position higher. Why? Because we are picking a bottom and there's a lot of more room to run. Raise the stop loss to break even, which is your entry price, once the initial target is met. That way you have a free trade. It's just a regurgitation of what I taught you in double bottom and triple bottom, but it works. So you see, once you master something, you can actually transfer some of the knowledge to another pattern. Now let's go back to the chart here. So make sure you have a left shoulder, head, right shoulder. Once you see this happening, always look at the neckline. Buy. You connect the highs after the left shoulder and before the right shoulder here. Okay, connect it to form a neckline. Buy the stop when it trades above this neckline. Okay, and you put the stop loss where? Below the head here, the stop loss. That is a conservative stop loss. If you want to be a bit more aggressive, you can put the stop loss higher here at the right shoulder. This is a swing low, one swing low, another swing low, another swing low. You put a stop loss below the right shoulder here. How do you get the target? Take the height from the neckline down to the head, and then you project it upwards from the breakout to get the target around here. Simple, right? Alright, let's look at the chart example. It's always good to look at a real chart example because you don't want to be only looking at drawings. You want to look at real things that are happening in the market so that it's not only textbook knowledge, but you can see it happening in real life itself. So we have what this Halliburton and oil stock drop, ooh, so scary, go back up, but drop again. Everybody's losing hope right now. But as it drops, it forms the left shoulder here, one low here, goes back up, and then goes way below the left shoulder here. Can you see that the head is lower than the left shoulder here? Goes back up to near the swing high here, and then it moves back down, but this time it doesn't go any lower. It doesn't go lower below the head. The swing low here is about the same as the left here. So we have a left shoulder, we have a head, a right shoulder, and it goes up. Once it breaks above this neckline, look what happened. The stock moves back up, but it drops. But then it moves back up. Now this can be very scary to a lot of people, but if you don't have any trade management or don't know how to manage head and shoulders, reverse head and shoulders pattern, but if you have learned about the pattern, where would your stop loss be? Conservative stop loss below the head, more aggressive around here. So did it go below the right shoulder or head? No. As long as the stock drops and stays above your stop loss, you're still alright. Eventually we have a bullish cross here where the 20 MA cross above the 50 MA, and look, boom, all the way it goes. Target, take the height from the neckline, this is the neckline, to the head, and project it upwards from the target. See, okay, it has already met, and more than that. So you will sell 1/3 when you reach the target, hold the other 2/3. Okay, raise your stop loss to break even. And in the previous section, I mentioned about the trend line, when you connect all the highs, as many highs as possible. Right, this is the trend line, this blue line here, you connect the highs, and when the stock breaks above a downtrend line, that is a sign that it wants to change trend. First sign that it wants to change trend is the area of value, and then we have the bullish cross, and which is why the stock moved up so high. So a very good example here in Halliburton. Let's see if we have. Okay, now we're going to look at the cup with handle chart pattern. Okay, next we'll look at the cup with handle pattern. The cup with handle pattern is a bullish reversal chart pattern that appears in many winning stocks before they move up higher. Now, this pattern was popularized by investing legend William O'Neill, who wrote the book How to Make Money in Stocks. And he's also founder of Investors Business Daily. Now I'm gonna type in William O'Neill. Okay, let's just show you Mr. O'Neill. Yeah, he is the one that wrote this book, How to Make Money in Stocks. So if you have the time, do go and have a read of his book, William O'Neill, How to Make Money in Stocks, a Winning System. It's not that expensive, and you can get there are many versions, but I think I have this orange color one. Okay, this is the book, and inside is so many excellent information on how to scan for stocks fundamentally, and he also combines it with technical analysis. It's a really very, very popular book, and if you have the time, do go and have a read of it. And of course, let me just go to investors.com. This is his website. This is the company that he started, Investors Business Daily, right? So if you buy the book and you're interested in using IBD's, Investors Business Daily's method and the tools, you can actually go to this website and subscribe. So a very useful tool. So let's just go back to the presentation. So this is the pattern. This cup and handle pattern was popularized by William O'Neill. As I said, he is the author of How to Make Money in Stocks. Definitely you should have a read of it. Okay, and what O'Neill discovered is that many of the biggest winners in the past have one characteristics in common. They have many characteristics, but one of the characteristics is a lot of them have this cup with handle patterns, and many of them have gone up to be big, huge winners over the decades. So therefore, you might want to pay good attention to this cup with handle, because who knows, you might find the next Google or Facebook or Apple. Now, this is what it looks like from a sideways point of view. So if you put a cup, a cup and sideways is what it looks like. So of course it's not like this. Is the price action, it goes down, and then it bottoms up, it levels straight sideways a bit, and then the stock price goes up and then trade sideways. Sometimes it's sideways, sometimes it's drifting lower, but you get the idea. Stock price is right like that. It refuses to go down again, but instead it's go up and trade sideways. So we call this the cup, and this is the handle. Okay, how do you trade the cup with handle? You buy the breakout of the handle. Okay, this is the bullish signal that the chart pattern gives you. So when it trades sideways, remember the handle is a sideways trading, and when it breaks out of the sideways trading, this is a bullish signal, actually a breakout. You put a stop loss below the handle, or if you are very conservative, put the stop loss below the entire chart pattern. So to get the initial target, the trader can take the height of the cup and project it upwards from the handle. And oftentimes the stock can go higher, so you might want to sell only half or one third of a position, just like in the previous section I mentioned to you, trade management, and let the remaining positions higher. And once your initial target has been met, raise the stop loss to break even so that you have a free trade. So let's go back to the chart here, the image. So when you see that handle, you buy the breakout when it trades above this handle here. Right? You can either put a stop loss below the handle here, which is about here. That's a bit more aggressive trade. And if you are more conservative trade, conservative trader, you can put stop loss below the entire cup with handle pattern. How do you get the initial target? You take the height of the cup to the base here and project it upwards from the handle here to get the target. Okay, so if you place a stop loss here and the target is so big, your reward to risk is going to be bigger. But if you put the stop loss here, then maybe it's like a 1-to-1 trade. But if you put the stop loss here, the reward is going to be higher. Okay, let's take an example. Hasbro. Watch, see how the stock drifts down, trades down, and then it goes up and trades sideways. Actually, it drifts sideways, but the drift a bit lower. So we can draw the cup here, and this is the handle. Can you see it? Okay, and I think there's a lot of people who saw this cup with handle, which is why there's no trading even here to break above, just gap up. So traders can buy the gap up above this handle. If you're more aggressive, put the stop loss here for a better reward to risk. And if you're less aggressive, put the stop loss here below the entire pattern. So take the height of this cup with handle, this cup, and project it upwards to get the initial target, which it met. So it was quite a long time before it went up here, but you know, when the cup and handle forms and we have a bullish cross here, this is a very powerful signal that the stock wants to go higher. So if you have placed a trade, you bought here, put the stop loss here, okay, you see such a big reward to risk trade, Hasbro. Alright, let's take a look at another example, Huntington Ingalls. Okay, you can see that the stock sold off, right? And then it rose and traded sideways here. Now notice, if you notice carefully, there's actually a double bottom here. See, this is a pattern within a pattern within a pattern. So the first sign of a bullish reversal you can see in the double bottom, and then you have this cup with handle pattern. So a trader can buy the breakout, place a stop loss here, or if you're less aggressive, place a stop loss below the entire cup. Take the height of this pattern, project it upwards from the breakout. So you get a target on here. The stock has met its target. And you also notice that the stock has a bullish cross here, and that's why it has a very nice run up. So if you place a stop loss here, I think your reward to risk might be 1.5 to 2 times. So that's the power of this cup with handle pattern. Alright, let's continue and look at the next chart pattern, the ascending triangle. And this is what an ascending triangle looks like. If you read textbooks and other websites, you probably come across this ascending triangle. It's being taught as a continuation pattern. But did you know that it can also be a bullish reversal chart pattern? You can often find this pattern appearing at support areas of value. So we're going to deal with the ascending triangle as a bullish reversal chart pattern in this video tutorial. So what happens with the ascending triangle is that the stock starts out very, very wide. You can see it's wide, and then it moves up, it goes back down, but this time a bit higher low, and it goes up back again to make the same highs, and it sells off a bit, but this time it reverses back up with a higher low. It makes the same high, it declines and make a higher low, and eventually it breaks out. So when you connect the highs, it's almost the same, and the lows, if you connect the lows, they actually make a higher low, and together when you draw these two trend lines, it looks like an ascending triangle. We call this a volatility contraction pattern because it starts up very wide, and then the the trading action contracts. So when something is very wide and then it contracts, eventually it's like a spring, you know, eventually it breaks out higher, and we call this a volatility contraction pattern. And volatility contraction pattern is actually very powerful, because when a pattern contracts, eventually what happens is price action will expand again, and it's good for us if we want to buy the stock. So how do you trade the ascending triangle? A trader should buy the breakout, and then the moment the stock by the breakout, the moment it breaks above the upper trend line, okay, and you put a stop loss along the lower trend line. Where the trader put a stop loss depends on how risk tolerant they are. Later I'll show you, okay, because it has a rising lower trend line, you can actually have many different areas of stop loss depending on how aggressive you are. So aggressive trader might want to put a stop loss below the first low. A more conservative trader might want to put a stop loss below the entire pattern. And we can get the initial target by taking the height of the pattern and projecting it upwards from the breakout. Let's go back to the image here. So you buy the breakout when it trades above this upper trend line. And where can you put a stop loss? Along the lower trend line. If here's a swing low, here's another swing low, here's a swing low, but it's a high low. Depends on how aggressive. If you're aggressive, you can buy a breakout, put the stop loss here. If you're less aggressive, you can move to the next higher low, put a stop loss here. If you are less aggressive here, and if you're very conservative, you can put the stop loss below the entire pattern here. How do you get a target? You take the height at its widest and you project it from the breakout area to get the target. Okay, that is how you get the initial target. Now let's take a look at an example. INSEE is a very good example. Okay, INSEE is a good example of ascending triangle as a bullish reversal chart pattern. Now notice it has been moving down. It's below the 20 MA, below the 50 MA, and then we see the ascending triangle form about the same highs, higher lows, and soon the stock goes back above the 20 MA and the 50 MA, and it breaks out above the highs. This is when the trader should buy, and you get the initial target by taking the height and projecting it upwards from this breakout area. So at this moment the target has been met. Actually it went higher, and because it's trading at the declining 200 MA, maybe trader can take more positions off, because this is a resistance area. 200 MA can be also a resistance, and the stop loss can be placed, like I said, depending how aggressive you are. So the swing low here, you can place stop loss here, or you can place a stop loss at the swing low here, or if you're really conservative, you can place stop loss here. Now the next pattern we're gonna learn is the triangle chart pattern. This triangle chart pattern is actually kind of about the same like the ascending triangle. The difference is that the upper trend line slopes lower, the lower trend line slopes higher. So it's also a volatility contraction pattern. You remember the ascending triangle, the highs are about the same, right? But the triangle, right, the highs go lower and the lows go higher. So you can draw a trend line, connect them, and this is a triangle, and this is the apex. Now the good thing about this triangle pattern is that it actually also gives you a time target. So usually when the pattern contracts and about to reach the apex, you can expect a breakout. Now this is a non-directional pattern. You can either break out or break down. But if you see this triangle chart pattern appearing at a support area, most likely it's going to break out higher. Now how do you trade the triangle pattern? The trader should buy the stock the moment it breaks above the upper trend line. Stop loss can be put along the lower trend line. The more aggressive you are as a trader, the closer you can put the stop loss. For more conservative traders, you can put a stop. For the more conservative traders, you can put the stop loss below the entire pattern. And to get the initial target, you can project the height of the pattern upwards from the breakout area. And if the stock starts a new uptrend, it can go way higher than the initial target. Let's look back at the image here. So you have a triangle. The moment it breaks above the upper trend line, you buy the breakout, and you can put the stop loss along this trend line depending on how aggressive you are. You can put a stop loss at this swing low here, or here, or here, or if you're less conservative, you put it at the bottom of the entire pattern. To get an initial target, you take the height of this pattern, project it upwards from the target. Okay, so if you're scared of whipsaws, you put your stop loss further away. But generally, if this stock is strong, it's very rare that it will drop back to below the apex. So it makes sense to put a stop loss around here, because strong stocks, it will just move up. When your stop loss is near to your breakout point, your reward to risk is higher. But do remember, when your reward to risk is higher, there's a possibility of more whipsaws as well. So do take that into consideration. Now let's take a look at MAA. MAA has been in a downtrend, below the 20 MA, below the 50 MA, below the 200 MA, very bearish. But then it forms a triangle, right? It makes a higher low here, higher low here. You can connect the lows and the highs here to form a triangle. You can buy the breakout, put a stop loss here, here, or here, depending on how aggressive you are. And the initial target, take the height, project it upwards to get a target. And at this moment, target is met. So there's a bullish cross here. Maybe it might start a new uptrend. We don't know. But at least the first target is met. MLM is another example. Stock drops to here, and it's actually trading sideways, forms a triangle at what? An area of value. Remember I told you about the 200 MA, where there's an area, it is an area of value, and when the 200 MA is flat, there's a possibility that the stock is going to move higher. So we have a triangle form at an area of value. Buy it when it breaks out above the upper trend line. You can put a stop loss here, here, or here. Remember I said that if a triangle is the stock is very, very strong, it rarely drops back below the apex. See, move all the way up, and if you put a stop loss here, look at your risk to reward. Reward to risk ratio is very good, and there's a bullish cross here. Take the height, project it upwards. Initial target has been met, but you can continue to ride the trend higher. Sometimes you can just use the 50 MA as a trend following tool as well. The moment it drops below the 50 MA, you sell the entire position. Well, since this is not a trend following video, we won't go too much into detail, but I think you kind of know what I mean, and learn some trend following techniques, and you'll be able to take advantage of the chart pattern and ride the trend higher as well. Okay, now let's look at another chart pattern. It's the rounding bottom. The rounding bottom looks like this. The stock sells off, but eventually the stock cannot go any lower, and it starts to kind of trade sideways and make higher lows here, higher lows here. When you look at the entire pattern, it looks like a rounding bottom. Okay, you can often see this happening in many stocks that have really bottomed and about to start a new uptrend. That's why it's very profitable if you can see this pattern and buy the breakout. So how do you trade the rounding bottom? Traders can buy the breakout above the consolidation that is formed during the rounding bottom formation. The stop loss can be placed at the bottom of the entire chart pattern. take the height of the consolidation, project it upwards from the breakout to get an initial target. And as I said, if the stock is really bottoming and start an uptrend, this stock can go way higher than the initial target. Let's go back to this chart and see. So there will be a sideways consolidation. You can actually draw the lines up, the upper trend line, lower trend line, and just buy the stock when it breaks out above the upper trend line. You put a stop loss below the lower trend line and ride it higher. Let's take an example. This is MHK, and you can see that it was in the stage 4 downtrend. If you have time, go to my website, thestockmarketanalysis.com. The web address is here, and you look for a guide called the 4 stages of the stock market. So in the article you'll learn about the stock market stages, stock market the cycle. When you want to buy the stock is when it's beginning to start a new stage 2 uptrend. And here we have the stock at the stage 4 downtrend, below the 20 MA, below the 50 MA, and there's a rounding bottom here. If you can see it, actually this is a rounding bottom, lows here, higher low, and you can take the entire consolidation here, right? Draw an upper trend line here, the lows here, you buy it when it breaks out above this line, put a stop loss here, and you can take the height of this pattern, project it up from the breakout to get an initial target. Initial target has been met, and this stock is probably starting a new stage 2 uptrend, which means it could go way higher. There is a bullish cross here. Now, sometimes you can be more aggressive and put your stop loss below the most recent swing low. So when you look at this stock, where is the most recent swing low? It's here, isn't it? This is the most recent swing low. You can buy the breakout here, put the stop loss here, and your risk reward to risk ratio will be higher, because a good stock will rarely drop below the breakout area. So might as well use this knowledge and have a greater reward to risk ratio. Or if you're less aggressive, you can put the stop loss here, and if you're conservative, put the entire stop loss here. Now let's move on to the next chart pattern, the falling wedge or the bullish wedge. Now the falling wedge is like this. It's a previous sell off, move down, and then you can see the stock trades kind of like this, where it makes a high, low, and then you connect the upper highs and you connect the lows. You will see that the highs is actually steeper than the lows here. And when you connect the highs and the low, it looks like a falling wedge. And this is actually bullish, because when the stock breaks out of the upper trend line, it's going to move up. So this falling wedge is actually a bullish situation. How do you trade the falling wedge? The trader can buy the breakout above the upper trend line for a bullish trade. And if the stock breaks below the lower trend line, then the pattern is not valid and you should not take the trade. So where it breaks out is very important. Breaks upper trend line, you take the trade. Breaks the lower trend line, the pattern is invalid and you shouldn't trade it. That's the rule. And you put the stop loss below the entire wedge. To get the initial target, simple. Take the height of the wedge at its widest point and project it upwards from the breakout. So let's go back to this image. So where do you buy? This trend line, upper trend line. Buy when it breaks out. Put the stop loss below the entire wedge pattern. Take the height of the wedge at its widest point. Project it upwards from the breakout to get an initial target. Okay, let's take a look at example. PCAR. Now, we have two falling wedge here. You see the beauty of learning chart patterns. When you recognize a pattern, sometimes the chart is very nice and the stock is very nice, and it gives you two chart patterns, two same chart patterns within the chart. So the first falling wedge happened around mid-July or mid-June to July. The stock drifted sideways. Right? You can connect the highs here and the lows here. You see the upper trend line here is actually steeper than the lower trend line. And we actually have a failed pattern here where the stock dropped below the lower trend line, but it quickly reversed back up. Now, a stock that have a failed pattern but quickly recover is actually much more bullish than original pattern, because everybody was trapped here and suddenly it goes back up. So it becomes more and more bullish. And look how the stock moved up so much after it broke above this upper trend line. You take the height of this pattern at this wider sweep and project it upwards from the breakout to get an initial target. First initial target, and then you write the other positions higher. And in mid-August, it actually drifted down again. Here we have another falling wedge. You connect the highs, connect the lows. You can see the upper trend line is steeper than the lower trend line. Buy the stock when it breaks out. Put a stop loss here. Take the height, project it upwards, get an initial target. But at this time, the stock is starting a new uptrend, a bullish cross here. And even though it traded sideways for some time, eventually went up. So never underestimate the power of falling wedge. Okay, it can actually give you a very good reward to risk ratio trade. Next chart pattern we want to look at is the bullish breakaway gap. It's not really a chart pattern which you often see in textbook, but it's something that appears quite often that I want to put it as a chart pattern here. It's called the breakaway gap. The breakaway gap is happens when the stock suddenly breaks, gaps up above a resistance area, a consolidation area, and this consolidation area can actually be other chart patterns like double bottom, triangle, ascending triangle. And when you see a stock gap up above this sideways trading, it's actually even more powerful because it tells bulls are very, very bullish. Now, how do you trade the bullish breakaway gap? The stock gaps up above a significant area, like a resistance, and this can happen because of good news or good earnings report. Then the trader can buy the gap up and put a stop loss below the nearest swing low. If there is another bullish reversal chart pattern, like say like a triangle, ascending triangle, or double bottom, if there's another bullish reversal chart patterns that appear before the gap, then your trade management should follow that of the chart patterns trade management steps. Okay, let me give you an example. We have PGR here, sold off, it actually gapped down, but refused to go down more, and it starts to go up. Then we can draw a trend line here. It gap up above this trend line. There's a bullish cross here, and what you can do is to buy the stock as it gaps up, put a stop loss here, the nearest swing low, or if you're more conservative, you can put a stop loss below the entire area here. So look what it did. Gap up, move up, then it scared some traders, but eventually it went back up. Okay, it's a very good thing when the stock gaps up and then a bullish cross appears, because you know there's a likelihood of a new uptrend forming. And if you have put a stop loss here, look at your reward to risk ratio. So congratulations on sitting for so long, listening to lessons about different chart patterns. And actually the bullish reversal chart patterns enables you to know how to spot a bottom. And you have learned about 2, 4, 6, 8, 9 chart patterns, and these chart patterns will enable you to know how to spot the bottom in stocks, in the market. And whenever you see your stock and you want a bottom fish, you have to ask yourself this question:
Does my stock exhibit these patterns? Is there a double bottom? Is there a triple bottom? Is there a rounded bottom? And so on, so forth. You can actually print this thing out and stick it next to your screen, next to your computer. And every time you see your stock forming this, go back to the rules that I've mentioned in previous section. Let's say you see a triple bottom, go back, look at the examples and see whether your stock is actually exhibiting the triple bottom. And yes, just follow the rules, enter, and manage the trade. So I hope you have learned a lot from this lesson, and if you find it helpful, do subscribe and like my channel. Do subscribe to my channel and like this video, because it'll help with the algorithms. And thank you so much for staying to the end. And I hope this video has been very helpful to you. Okay, one final thing. I just want to say congratulations to you on learning how to spot a bottom in stocks. As a summary, you are now able, with the knowledge I've given you, you are now able to spot a bottom in stocks and also the major indices. And you can use the knowledge of these bullish reversal chart patterns in other instruments like commodities and cryptocurrencies. And you now know how to buy stocks as they are bottoming. You also have learned to know where to put a stop loss with regards to each chart pattern, and you also know how to be realistic and set profit targets for your trade. And of course, I hope that with this knowledge you will know how to make money in the stock market. So thank you for watching to the end, and hope this helps you, and I'll see you in the next one.